On the last day of November 2024, the People's Bank of China published a line item in its monthly Foreign Exchange Reserves report. Official gold holdings, 2,280 tons, a number released with the same bureaucratic dryness as any other line on any other central bank balance sheet. But sit with that figure for a moment, because it tells only part of a story that several of the most analytical desks on Wall Street believe is being deliberately understated. Goldman Sachs, Societe Generale, the World Gold Council, Japan's Nikkei. When their analysts model what China actually holds across the People's Bank, the State Administration of Foreign Exchange, the sovereign wealth vehicles, and the entities that move metal without crossing the official ledger, the estimates climb. 5,000 tons, 6,000. Some run the math out towards 7,000 or more. That is not a confirmed figure. It is an upper bound estimate, and it deserves to be treated as one. But the gap itself, between roughly 2,280 tons reported and an estimated several thousand tons actually held, is the story. Because if those analysts are even directionally correct, the second largest economy in the world has spent the last decade and a half quietly building one of the largest gold positions in modern history and telling almost no one how much it actually has. This is not how central banks normally behave. To understand why, you have to understand what a typical reserve manager does in a typical year. A central bank in a mid-sized economy might add 5 tons of gold in a strong year, 10 in an exceptional one. 20 would be a notable event written up in the financial press. The People's Bank of China, in its officially reported buying spree from late 2022 through mid-2024, was adding gold at a pace that in some months exceeded what most European central banks hold in total, tons per month. 18 consecutive months of reported additions before the official channel paused in mid-2024. And the analyst desks that have done the work suggest the unreported buying, the metal that arrives through SAFE, through sovereign wealth vehicles, through state-owned banks acting as intermediaries, through the Shanghai Gold Exchange, never paused at all. What the world watched in the official PBOC figures may have been the tip of an iceberg that has been growing, mostly underwater, since the financial crisis of 2008. To see how a country gets here, you have to walk it backward. In April 2009, the People's Bank of China announced, almost in passing, that its gold reserves had risen from 600 tons to 1,054 tons. Then the announcement stopped. For 6 years, from 2009 to mid-2015, China published no update on its official gold holdings. 6 years of silence in which the country continued to be the world's largest producer of gold, mining roughly 370 tons a year, with almost none of it leaving the mainland. 6 years in which Chinese banks were buying gold on international markets, in which the Shanghai Gold Exchange, founded in 2002 as a yuan-denominated price discovery venue, grew into one of the largest physical gold markets in the world. When PBOC finally updated its figure in July 2015, the number had jumped to 1,658 tons, a 57% increase that nobody outside of Beijing had been able to verify in real time. The pattern was clear. China would tell the world about its gold when China was ready to tell the world about its gold. And the gap between what was reported and what was suspected had been a feature of the system from the beginning. The strategic backdrop for this accumulation matters more than the tonnage. After 2008, after the United States and Europe responded to the financial crisis with quantitative easing programs that expanded central bank balance sheets by trillions of dollars, Chinese officials began making increasingly direct public statements about what they viewed as the risks of holding dollar-denominated reserves. The yuan internationalization push accelerated. In 2015, China formally applied for the renminbi to be included in the IMF's special drawing rights basket. In October 2016, that inclusion took effect, placing the yuan alongside the dollar, the euro, the pound, and the yen as one of the world's official reserve currencies. The infrastructure was being built. The Shanghai Gold Exchange International Board opened in 2014 to allow foreign participants to trade gold settled in yuan. CIAPS, the cross-border interbank payment system, was launched in 2015 as a yuan-denominated alternative to dollar-based settlement rails. None of it, individually, threatened the dollar's dominance. All of it together looked like the careful, patient construction of an alternative. And then came February 2022, when Russia invaded Ukraine, the United States, the European Union, the United Kingdom, Canada, Japan, and a coalition of allied governments froze roughly $300 billion of Russian central bank reserves. The technical mechanism was straightforward. Russian state assets held in Western financial institutions were rendered unusable through coordinated sanctions. The political signal was something else entirely. For the first time in the modern history of the international monetary system, the holders of the world's reserve currency had taken a great power central bank's foreign exchange holdings and turned them off. Not seized them yet, though the conversation about confiscation followed, but immobilized them, made them, in real terms, no longer the property of the country that had earned them. Every reserve manager outside the Western alliance system watched this happen, and every one of them, from Riyadh to New Delhi to Pretoria to Brasilia, asked the same question. Could that be us? If our relationship with Washington ever sours past a certain point, could our dollar reserves, the savings of a generation of our exporters, simply stop existing? The answer, after February 2022, was that yes, in principle, they could. And the implications of that answer rippled outward through every reserve management committee in the Global South. This is where a useful historical parallel earns its place. In August 1971, President Richard Nixon went on television and told the world that the United States dollar would no longer be convertible to gold at the fixed rate of $35 an ounce that had defined the Bretton Woods system since 1944. The shock was the same kind of shock. A foundational assumption about how the international monetary system worked had been suspended unilaterally by the country that held the reserve currency. Before 1971, foreign central banks understood that their dollar holdings were, in extremis, redeemable for metal. After 1971, they understood that the dollar was backed by the credibility and willingness of the United States Treasury and nothing else. That worked for 50 years, mostly because the alternatives were worse and because the United States had built the deepest, most liquid financial markets in human history. But the social contract had changed in 1971, and the social contract changed again in a different direction in 2022. Non-Western central banks were now responding the way central banks have always responded when paper assets become politically conditional. They were going back to the one thing on the balance sheet that nobody can switch off. Gold doesn't have a counterparty. That is the whole reason it has survived. In central bank vaults for as long as central banks have existed, a bar of gold sitting in your own vault is not someone else's promise to pay. It is not a SWIFT message that can be blocked. It is not a treasury security that can be sanctioned. It is mass and atomic number and density, and it has been doing this same job for 5,000 years, and it probably does not care which empire is in charge this decade. When central banks lose trust in each other in every other language, gold is the one they still speak. The actual buying tells you what the policy response looks like in practice. From November 2022 through April 2024, the People's Bank of China reported 18 consecutive months of gold additions to its official reserves. The pace varied. Some months 30 tons, some months 10. The GOG cumulative increase carrying official holdings from roughly 1,248 tons before the spree to over 2,160 tons by spring 2024. Then in May 2024, the official editions paused. The financial press largely reported this as China stepping back from the gold market. The reality, according to multiple analyst desks, was almost certainly more complicated. The Shanghai Gold Exchange continued to record extremely strong physical withdrawals. Premiums of Shanghai gold over the London benchmark widened at various points during 2024 to levels sometimes 40, 50, even briefly higher dollars per ounce, that imply Asian demand running well in excess of available supply. Bullion was being physically withdrawn from London vaults at notable rates, and showing up by various trade flow inferences in destinations that pointed eastward. The Goldman Sachs analysis from late 2024 walked through the discrepancy. Their commodity strategy team, working from import data, mine production figures, jewelry demand estimates, and custom statistics, suggested Chinese state buying was running at multiples of what the PBOC was officially reporting. Société Générale's metals desk had produced similar work. The World Gold Council, which tracks reported central bank purchases globally and has been pointing out for years that the numbers don't fully add up, has acknowledged that unreported sovereign demand from Asia, and from China specifically, appears to be a structural feature of the modern gold market. None of these analysts will commit to the upper bound figure of 7,000 tons as a confirmed number. It is, again, an estimate. A reasoned one, built by people whose job is to model these flows, but an estimate. The honest range that emerges from the serious analytical work runs from roughly 5,000 tons on the lower end to 7,000 or more on the upper end, against a reported figure of about 2,280. Whichever end of that range you believe, the implication is the same. China's gold position is larger, possibly significantly larger, than the official ledger reflects. The mechanism for the gap is not particularly mysterious. The State Administration of Foreign Exchange, SAFE, sits adjacent to the People's Bank and manages a portion of the country's foreign reserves with somewhat different reporting obligations. The China Investment Corporation and other sovereign wealth vehicles can hold gold and gold-related assets without those holdings necessarily appearing on the PBOC line. State-owned commercial banks can act as intermediaries, taking delivery of physical metal that may or may not eventually migrate into official reserves. The Shanghai Gold Exchange settles trades that involve state-affiliated counterparties. None of this is illegal under any international framework. Reserve composition disclosure is a matter of national discretion, and many central banks, not only China's, provide less than full transparency about exactly what they hold and where. What is unusual about the Chinese case is the apparent scale of the gap, combined with the strategic context in which the gap is being maintained. The strategic context, again, is the slow drift of the international monetary system. The dollar's share of allocated global foreign exchange reserves, according to the International Monetary Fund's COFR data, stood at around 71% in 1999. By the most recent quarterly figures available, that share had declined to roughly 58%. 13 percentage points of erosion across a quarter century, not a collapse, but a discernible and persistent drift. The euro has not absorbed that drift. The yen and the pound have not absorbed it. What has absorbed it, in part, is a basket of so-called non-traditional reserve currencies: the Canadian and Australian dollars, the Swiss franc, the Singapore dollar, and increasingly, the renminbi, and, notably, gold. Central banks globally have been net buyers of gold every year since 2010, with the pace accelerating sharply after 2022. The People's Bank is the most visible buyer, but it is far from the only one. Turkey, India, Poland, Singapore, the Czech Republic, Hungary, Qatar. The list of central banks adding to gold reserves in recent years reads like a survey of countries thinking carefully about the durability of dollar-denominated savings. BRICS expansion in 2024, when Egypt, Ethiopia, Iran, and the United Arab Emirates formally joined the original 5 members, added another dimension. The expanded grouping now includes some of the largest energy producers and largest energy consumers in the world. Bilateral and multilateral discussions about settlement alternatives, yuan-settled oil contracts with Saudi Arabia, ruble-yuan trade with Russia, rupee-dirham arrangements between India and the Emirates have moved from theoretical to operational. The petro-yuan is no longer a hypothetical. It is a small but real share of global oil settlement, and the share is growing year over year. Each of these arrangements, taken individually, is marginal. Taken together, they sketch the outline of an alternative settlement architecture that does not depend on the dollar for every transaction. It is worth being careful here about what this does and does not mean. The dollar is not going to lose its reserve status next year, or the year after, or probably within this decade. The depth of dollar-denominated capital markets, the size of the U.S. Treasury market, the willingness of the United States to run sustained current account deficits and supply the world with dollar liquidity. These are not features that any other currency can replicate quickly. The yuan in particular faces structural constraints. China maintains capital controls. The renminbi is not freely convertible. Foreign investors holding yuan-denominated assets face restrictions on how easily they can move that capital in and out of China. Until those constraints change, the yuan cannot fully substitute for the dollar as a global reserve asset. What the yuan can do, and what gold can do alongside it, is provide an alternative at the margin. Not for everything. For the transactions and the holdings where political risk is the dominant consideration. That is what makes the gold accumulation strategically coherent. Gold doesn't need to displace the dollar. It needs to provide a backstop, a politically neutral asset that sits on the balance sheet alongside dollar holdings and yuan holdings and gives the reserve manager a non-correlated, non-confiscatable position to hold during periods of geopolitical stress. If China and Russia and Turkey and India and the rest of the buyers succeed in rotating even a meaningful minority of their reserves into gold over the next decade, the implications for the structure of the international monetary system are substantial. Not dramatic, not collapse level, but substantial. Run the math forward. If, hypothetically, 30% of global dollar-denominated foreign exchange reserves were to rotate into gold or yuan-denominated assets over the next decade, the mechanical implications are several. The pool of foreign demand for U.S. Treasury securities would shrink at the margin. The yield on long-dated treasuries would, all else equal, drift higher to attract the marginal domestic buyer who replaces the marginal foreign seller. The Federal Reserve would face increasing pressure to absorb treasury supply through balance sheet expansion. The dollar exchange rate would face downward pressure against gold and against the currencies of the countries doing the rotation. None of this happens in a single day. All of it happens gradually, through thousands of individual reserve management decisions made by central banks that are not coordinating openly, but are responding to a shared set of incentives. That is what a slow-motion monetary realignment looks like. Not a phone call to announce a new system. A decade of quietly shifting allocations until one morning the composition of global reserves looks fundamentally different than it did when the shift began. The physical evidence of the shift is already visible if you know where to look. Walk into the vaults beneath the Shanghai Gold Exchange and the stacks of bullion. The 1,000-ounce bars stamped with refiner marks from Switzerland and South Africa and Australia have grown taller year over year. Walk through the loading bays of the London Bullion Market Association vaults and the metal has been moving in the other direction, leaving Europe, crossing through Zurich and Dubai, arriving in Hong Kong and Shanghai. The trade data captures it. The customs statistics capture it. The aggregate flow of physical gold from Western vaults toward Asian destinations has been one of the structural features of the bullion market for more than a decade, and it has accelerated since 2022. This is not speculative trading. This is metal being moved, physically, from one part of the world to another, and not coming back. There is one more layer worth naming. China's gold reserves, whatever their true total, sit at the intersection of three different strategic objectives. They support the credibility of the yuan as a future reserve currency by demonstrating that the People's Bank has the kind of hard asset backing that historically gave reserve currencies their credibility. They provide insurance against the same kind of reserve freeze that hit Russia in 2022. And they position China as the central price-setting venue for physical gold in Asia through the Shanghai Gold Exchange, which over time could rival the London and New York benchmarks that have set the global gold price for the better part of a century. Three objectives. One asset class, pursued patiently over a decade and a half, mostly outside the daily attention of the financial press, with periodic public disclosures that almost certainly understate the true scope of what has been built. Which brings us to where the world actually sits in 2025. The official PBOC figure is just over 2,280 tons. The analyst estimates of true Chinese state gold holdings range from roughly 5,000 tons on the conservative end to 7,000 or more on the upper end, with the caveat that all of those numbers are inferred rather than confirmed. The pause in officially reported buying that began in mid-2024 has not, by any of the available evidence on physical flows and Shanghai premiums, corresponded to an actual pause in accumulation. The de-dollarization trend in global FX reserves is measurable, persistent, and visible in IMF data. The infrastructure for non-dollar settlement is operational and growing. The BRICS bloc has expanded. The Russian reserve freeze remains the precedent that every reserve manager outside the Western alliance system carries in mind when they make allocation decisions. The question that hangs over all of this is whether what we are watching is the early middle phase of a genuine slow-motion monetary realignment, or whether it is a marginal adjustment that will plateau before it materially changes the structure of the international financial system. There are credible arguments in both directions. The case for plateau rests on the structural advantages of the dollar, the depth of U.S. capital markets, the absence of a true alternative, the entrenched habits of global commerce. The case for realignment rests on the persistence of the de-dollarization data, the steady accumulation of gold by non-Western central banks, the political dynamics that 2022 set in motion, and the patient construction of alternative settlement rails. Reasonable people disagree about which case is correct. What is harder to disagree about is that the question itself is now serious in a way it was not a decade ago. There is one final thing worth saying, and it is the thing that most coverage of the gold story tends to miss. The relevant question is not whether you, as an individual, should hold gold or not hold gold. That is a question for you and the people who advise you on your own financial situation, and nothing in this video should be taken as guidance one way or the other. The relevant question is what the structure of the global monetary system looks like in 10 or 15 or 20 years if the central banks that hold the world's savings continue to act on the conclusions they appear to have drawn from 2022. Because that structure shapes everything else. It shapes interest rates. It shapes exchange rates. It shapes the cost of capital for governments and corporations everywhere. It shapes the ability of the country that holds the reserve currency to run sustained deficits at low cost. It shapes the geopolitical leverage that the reserve currency provides. And it is being shaped right now by decisions being made in vaults and trading rooms and central bank boardrooms in dozens of capitals, mostly outside the daily attention of the public, mostly without any single dramatic event to mark the change. The history of monetary regimes suggests that they do not usually end with announcements. They end with slow shifts in behavior that, in retrospect, were visible for years before anyone formally acknowledged that the old order had passed. The British pound did not lose its reserve status in a day. The Bretton Woods dollar regime did not collapse on August 15, 1971. That was the date of the formal acknowledgement, not the moment the underlying tensions began. The patterns of central bank gold accumulation we are watching now may be telling us something similar, or they may be telling us nothing of the kind, and the dollar's position may prove more durable than the early evidence suggests. We do not yet know. What we do know is this. Somewhere in vaults, in Beijing and Shanghai and the secondary depository sites that the People's Bank does not publicly identify, there is a quantity of gold, possibly the largest such quantity ever assembled by a single state in modern history, that is not being disclosed in full to the international financial community. We know that the accumulation has accelerated since the Russian reserves were frozen in 2022. We know that other central banks, watching the same precedent, have been doing versions of the same thing on smaller scales. We know that the share of the dollar in global reserves has been drifting downward for 2.5 decades. And we know that the question of what the international monetary system looks like in 2035 or 2040 is now genuinely open in a way that it was not in 2020. Whether the next chapter of that story is gradual or accelerated, whether the policy response from Washington reshapes the trajectory or accommodates it, whether the rest of the world's reserve managers continue to drift in the direction that the data currently suggests, none of that is settled. It is being decided, one allocation at a time, in dozens of capitals, with most of the decisions unreported and most of the consequences still distant. The metal sits in the vaults. The ledgers, official and unofficial, continue to grow. The question that should be on the table is not whether China is buying gold. That is a settled fact. The question is what the country that issues the world's reserve currency does when the reserve managers, quietly and persistently, are telling it that the terms of the relationship may need to change. That is the question for the next decade, and it is the question we will keep returning to on this channel, because the answer, whatever it turns out to be, will shape almost everything else.